So here's a scenario that I think a lot of people quietly live in. You're earning good money, maybe not rich on paper money, but solid. More than your parents made at your age. More than you ever thought you'd be making when you were starting out. And yet, the number in your investment account doesn't really seem to move the way you expected it to. You're not broke. You're not irresponsible. You don't have an obvious problem you can point to. But there's this background hum, this low-grade financial unease, that just doesn't go away, no matter how many times you refresh the balance. And the confusing part is that you know people who earn less than you and seem to be doing better. They're talking about buying a second property. They max their Roth in February. They're not stressed about money in the way that you quietly are. So you start looking for an explanation. And every article you find says the same things. Spend less, earn more, invest the difference. And you think, okay, I'm doing that. Kind of, mostly. So why isn't it working the way it's supposed to? Here's what nobody tells you. The problem usually isn't the behaviors on the surface. It's 3 specific patterns running underneath them. Patterns that have nothing to do with how much you earn and everything to do with how you relate to money at a psychological level. And the reason they're so hard to catch is that each one of them looks from the outside like you're doing fine. So what I want to do today is walk you through 3 signs, real specific, psychologically grounded signs, that your wealth building is quietly broken, not because of your income, not because you're bad at math, but because of 3 patterns that most high earners never catch until it's too late. And fair warning, some of what I'm about to describe is going to feel uncomfortably familiar. That's intentional. Let's get into it. Sign 1. You let your financial thermostat reset with every raise. Okay, this one is going to sound like common sense at first, and then I'm going to show you the mechanism underneath it, and I think it's going to reframe something you've probably never quite been able to articulate. Here's the thing about raises. Most people experience them as progress, and in a narrow sense they are. More money is more money. But here's what the data actually shows. In a study published in the Journal of Economic Behavior and Organization, researchers tracked household spending across income increases over multiple years. What they found was that for the majority of households, every $1 increase in income led to somewhere between 70 cents and $1.10 in increased spending within 12 months. Not 10 cents, not 30 cents. 70 cents to $1.10, meaning most people in the year after a raise either saved a fraction of it or actually overspent relative to their income increase. Economists call this lifestyle inflation, but that term undersells what's really happening. This isn't just buying nicer things, it's a full ratcheting of your baseline. The new car becomes your car. The nicer apartment becomes just where you live. The frequent restaurant meals become your normal. And critically, none of it can be easily walked back. Because now your monthly costs are higher. Your lifestyle requires more to sustain. Your financial floor has risen. Here's why that matters in a way most people never calculate. Wealth is not built by earning more. Wealth is built by the gap between what you earn and what you spend, and then what you do with that gap. Lifestyle inflation doesn't just slow wealth building, it actively shrinks the gap. Every time your spending rises to match your income, you are choosing a bigger present at the direct expense of every future version of yourself. Let me run the math, because this is where it gets uncomfortable. Say you earn $70,000 at 30 years old and you're saving 10%, $7,000 a year. Over the next decade, you get a series of raises. By 40, you're earning $110,000. That's a $40,000 income increase over 10 years. If you capture just 50% of each raise, meaning every time your income went up, you bumped your savings rate first, you'd be saving roughly $22,000 a year by 40. At a 7% average return, you'd be approaching $300,000 in invested assets by then. But if lifestyle inflation absorbed 90% of each raise, you're still saving around $11,000 a year by 40. Same salary, same time. You'd have roughly half the invested assets. That gap, the one created purely by whether you captured raises or spent them, compounds for another 25 years until retirement. The difference in final wealth isn't a little. It's potentially $1 million or more from the same income. And I'll be real with you, this is genuinely hard to resist. Your 30s and 40s are simultaneously the highest earning years of your career and the most expensive decade of your life. Kids, mortgages, cars, travel, the social pressure of a peer group that's also earning more and spending more visibly. The present is incredibly loud. Your future self is completely silent. The deeper principle here is one I find myself coming back to constantly. The people who build serious wealth on ordinary incomes almost always have one thing in common. They made the decision about what their life cost before the money arrived. They set a lifestyle budget that felt comfortable and then treated every dollar above it as money that belonged to their future, not their present. Not because they were disciplined in some superhuman way, because they built a system where the money went to savings before they ever had the chance to mentally allocate it elsewhere. Sign 1 that you'll never build wealth, regardless of income. Your spending has risen year over year at roughly the same rate as your income. If you've gotten meaningfully wealthier on paper, but your savings rate, the actual percentage of gross income going toward investment, hasn't increased over the last 5 years, the raise was absorbed. The thermostat reset, and it will keep resetting until you deliberately break the cycle. Sign 2. You're optimizing for comfort, not compounding. This is the one where people's eyes either light up or glaze over. And I'm going to ask you to stay with me, because what I'm about to describe is probably the single most invisible wealth-destroying pattern I've ever seen. Here's the setup. You've been working hard. You've made real sacrifices. You've saved money. You deserve to enjoy what you've built. The nicer home in the better school district, the car that doesn't make you anxious on long drives, the vacations that actually feel like vacations. This is reasonable. This is human. This is also for many people quietly lethal to long-term wealth. Not because comfort is bad, because of what comfort costs when it's purchased with assets instead of income. There's a concept in behavioral economics called mental accounting, identified by Nobel Prize-winning economist Richard Thaler. It describes the human tendency to treat money differently depending on where it came from or what category we put it in. And it shows up in wealth building in a specific, devastating way. Most people, when they reach a certain level of financial success, start making major spending decisions. The house upgrade, the car upgrade, the private school tuition, by asking, can I afford the monthly payment? And they can. The payment fits. The budget works. But the question they should be asking is, what is this decision costing me in compounded future wealth? Here's the math that changes how I think about every large purchase. A $650 monthly car payment, totally normal, totally common for a mid-range vehicle today, represents $7,800 a year. Over 5 years of payments, that's $39,000. But that's not the real cost. The real cost is what that money would have become if invested instead. $7,800 a year at 7% for 25 years is roughly $500,000. You didn't buy a car. You bought a car instead of $500,000. Now, before this turns into a lecture about never buying a nice car, here's the actual point. Most people never run this math. They feel the monthly payment. They never feel the opportunity cost. And this asymmetry, feeling the present cost clearly and not feeling the future cost at all, is why optimization for comfort consistently wins over optimization for compounding. The comfortable choice is always more emotionally vivid than the compounding choice. Dalbar, a financial research firm, publishes an annual study called the Quantitative Analysis of Investor Behavior. For decades, it has tracked the actual returns investors earn versus the returns the market produces. The gap is staggering. Over the past 30 years, the S&P 500 has averaged roughly 10.7% annually. The average equity investor has averaged around 6.8%. Same market, same time period. Nearly 4 points of annual underperformance. The reason isn't bad stock picking. The reason, according to the research, is behavioral. People buy when markets feel good. They sell when markets feel scary. They move money to more conservative investments after downturns instead of before them. They optimize at every decision point for what feels comfortable right now. This same pattern shows up in spending, in housing, in car purchases, in lifestyle choices. Comfort is the enemy of compounding. Not because discomfort is virtuous, but because compounding requires patience, consistency, and the repeated willingness to feel nothing exciting happening while the math quietly does its work. And I'll be honest, this is the one that gets educated, high-earning, genuinely smart people. They understand the theory, they could explain compound interest to you, but their daily decisions, the house they bought, the car they drive, the rate at which they've traded invested assets for lifestyle improvements, reveal that understanding the math and internalizing it enough to act on it are two completely different things. Sign 2 that you'll never build wealth regardless of income. You're consistently making major spending decisions based on affordability rather than opportunity cost. The question driving your financial choices is, can I handle this payment? Rather than, what is the future cost of saying yes to this right now? If you've never run a 25-year opportunity cost calculation on a major purchase, that's not a character flaw. Nobody teaches this. But starting to ask that question, even imperfectly, is one of the highest leverage things you can do for your financial future. Sign 3. You're confusing busyness with a plan. Okay, this one's a little more uncomfortable than the others. Stay with me. Here's something I've observed over years of being obsessed with this stuff. A lot of people who will never build serious wealth are incredibly active with their money. They check their accounts frequently. They read about investing. They open the app. They look at the balance. They have opinions about the market. They're engaged. They're trying. And yet, they don't have an actual specific written plan for what the money is supposed to do between now and financial independence. Psychologists have a name for this phenomenon: busyness bias, the tendency for humans to equate activity with progress. We feel more comfortable when we're doing something. Monitoring feels like managing. Reading feels like deciding. Checking feels like controlling. But none of those activities, in the absence of a clear plan, produce compounding wealth. Here's the specific way this plays out financially. A Vanguard study analyzing outcomes across their investor base found that on average, accounts where investors made the fewest changes, the ones that were essentially set, automated, and left alone, outperformed accounts with the most activity by a significant margin over 10-year periods. The most active investors, the ones checking constantly and making adjustments, earned less than the ones who essentially forgot about it. Let me be clear about what that means. The investors who were least engaged, who arguably felt the least informed and in control, consistently built more wealth than the investors who were most engaged. Activity was inversely correlated with outcome. This isn't because engagement is bad. It's because engagement in the absence of a pre-committed plan leads to reactive decisions. And reactive financial decisions, selling when the market is down because it feels scary, moving to cash when headlines are alarming, shifting allocations after a rough quarter, systematically destroy wealth at exactly the moments when patience would have built it. The deeper issue here is that I'm keeping an eye on it is not a plan. I'm diversified is not a plan. I'm in a target date fund is closer. But even that's not a plan unless you know what target you're aiming for and why. A real plan answers specific questions. What is your target number? The amount at which your investments can sustain your lifestyle without you working? What annual spending does retirement require? What savings rate do you need to reach your target by your target date? What allocation makes sense for your timeline? What's your strategy for the 5 years before and after retirement, when sequence of returns risk is highest? What happens to your plan if you lose your income for 6 months? If you can't answer those questions, like not perfectly but approximately, you don't have a plan. You have a feeling. And feelings are what the Dalbar data is measuring when it shows investors underperforming the market by 4 points a year. And I'll be real with you. The financial services industry has a structural incentive to keep you in a state of engaged uncertainty. An investor who is slightly anxious, slightly unsure, and checking their account regularly is an investor who might need advice. An investor with a clear, automated, boring plan that they understand and believe in doesn't need very much from anyone. That second investor is harder to monetize. This isn't a conspiracy, it's just an incentive structure. But understanding it explains a lot about why the information available to most people about wealth building tends to emphasize complexity, timing, and active management, when the evidence consistently says that simplicity, consistency, and patience are what actually produce wealth. Sign 3 that you'll never build wealth regardless of income. You're engaged with your money, but you can't clearly articulate your number, your target date, your required savings rate, and your plan for the withdrawal phase. If those questions produce a vague answer about having a 401k and trying to save more, that's activity, not a plan. And activity without a plan is what keeps smart, high-earning people perpetually busy and never quite ahead. Why the system didn't teach you this? I don't want to be dramatic about this, but I do want to be honest about something before we close. The reason most people who earn good incomes don't build serious wealth isn't laziness. It isn't stupidity. It isn't lack of trying. It's that the 3 patterns I just described, lifestyle inflation, comfort optimization, and busyness without a plan, are not random failures. They're the predictable output of a culture that teaches you to measure success by income, by visible lifestyle, and by how busy and engaged you feel. None of those metrics predict wealth. They just predict how financially comfortable you appear. Real wealth, the kind that buys you time, options, and the freedom to stop doing things you don't want to do, gets built in the gap between what you earn and what you spend, sustained over decades, guided by a specific plan. That's it. It's boring. It doesn't look like anything from the outside. And it's completely achievable by people earning ordinary incomes, which is why it's both encouraging and frustrating that it's so rarely actually happening. The good news, these are fixable problems. All 3 of them. They don't require more income. They require a different relationship with the money you already have. Let's land. This 3 signs you'll never build wealth, regardless of how much you earn. 1. Your spending has risen at roughly the same rate as your income over the last 5 years. The thermostat keeps resetting. The gap between what you earn and what you need stays the same no matter how much more you make. 2. You're making major financial decisions based on whether you can handle the payment, not on what the decision costs you in compounded future wealth. Comfort is winning. Compounding is losing. 3. You're engaged with your money, but you don't have a specific written plan with a target number, a target date, and a strategy for the withdrawal phase. Activity is filling the space where a plan should be. None of this requires a finance degree. None of it requires a wealth management firm charging you 1% annually to explain things you could understand yourself with a few hours of attention. What it requires is honesty about which of these patterns you're running and a willingness to build specific systems that interrupt them before they compound into a retirement you didn't actually plan for. Your future self is completely silent right now. They have no way to lobby for the decisions you make today. The only version of you that can change any of this is the one reading this right now. And if you've made it this far, if you watched a 15-minute video about your own financial blind spots, you're already doing something most people don't do. You're taking it seriously. That's not nothing. That's actually where it all starts. So go look at your savings rate from 3 years ago versus today. Run a 25-year opportunity cost number on the last major purchase you made. Write down in plain language your target number and your target date. Not because any of that is complicated, but because knowing these things, really knowing them, not just vaguely feeling like you should, is one of the most concrete things you can do for the person you're going to be in 20 years. I'm not a financial advisor, and none of this is financial advice. It's patterns I've watched play out with real numbers attached. Take what's useful and leave the rest. If this video changed how you think about your financial trajectory, subscribe. Drop a comment telling me which of these 3 signs hit closest to home. I actually read them. And I'll see you in the next one.